Welcome to the Introduction to Transfer Pricing. This is a series of videos to talk about the basics of the fundamentals of transfer pricing. Today's topic is going to be adjustments. And by adjustments, I mean talking about adjusting the data that one receives of the comparable firms to make them more similar or more comparable to the tested party in your comparable profits method analysis. So our focus of adjustments, there are many different types of adjustments you might make. Today's focus, we're going to talk about working capital adjustments, and in particular accounts receivable and accounts payable. The adjustments need to be made because there are differences between firms, and in particular in the terms that they might offer their customers as to when they need to pay their invoices, or there may be differences in the terms that a party has to pay in terms of buying product and how many days of, say, it's allowed before it pays its invoices to its suppliers. And those will have an impact on the financial statements and therefore will have an impact on how we do our transfer pricing. I like to think of these adjustments as a little bit like this image you see on the right, which is that we are custom tailoring these firms to make them a better fit for our tested party. And that's essentially the concept here of making an adjustment. Now, making adjustments is very common when doing a comparable profits method in the U.S. It's probably done and should be done in most cases for reports in the U.S., with the exception of saying there are times when economic factors might cause an adjustment to be inappropriate. We will discuss that topic in a later video. However, in foreign jurisdictions, often adjustments are not acceptable or not generally the practice, and it's best to coordinate with our colleagues who are experts in those other jurisdictions to find out what the implications are of making an adjustment in those markets. Now, I just want to introduce the concept of why an adjustment might be necessary, and it really comes down to the concept of the time value of money, which for most people who've done financial analysis, it should make perfect sense. But imagine that someone says the product is $100 and they offer you the following terms. They say, if you would sell me this, we'll sell you this product and you'll have to pay us within 90 days of when we invoice you. And that's equivalent to having sold it to me today at a much lower price because I get to keep my money for 90 days before I have to pay the invoice. In fact, in this simple example I'm going to use where we assume an annual interest rate of 1%, that's going to work out to be the equivalent of having bought it for $99.75. And you think, well, how does that happen? Well, because if I bought it today and I received the product and I don't have to pay the invoice for 90 days, I could take my $100, put it in the bank. It'll be earning an annual interest rate of 1%. That's pretty reasonable for today's rates, or at least a good example. And that means in 90 days, I would earn 25 cents of interest. And so when I pay 90 days from now, I will get to pay $100, but I get to keep the 25 cents of interest I would have earned from keeping my money in the bank. Alternatively, someone might offer me the option of saying, if you pay cash today, I'll give you a discount. And it's the same concept. I'd say, well, at what point would I be indifferent between cash today, paying it cash today, and getting a discount versus getting 90 days of credit? And that point would be, if they offer me a discount of taking it down to $99.75 or even something lower, I'd be more than happy to take that transaction and say, yes, because that's better than I can do if I put the money in my bank and waited 90 days in order to pay you. So you can see that there are two things that are going to affect this analysis. Whether interest rates are high or low, because if interest rates are very high, then the time value of money becomes much more important. And also, how long is the time period before I have to pay something or before I'm going to receive my money, as you can think about this problem from either side of the transaction. Now, the important thing for us in doing this analysis is that offering payment terms, like not having to pay immediately, is going to change the income statement in some important ways, and that's going to affect how we look at our analysis, especially if our analysis is based upon an operating margin. We're really definitely going to need an adjustment in that case. So we talk about accounts receivable and account payable adjustments, and we think of it in terms of the difference between a cash sale and a sale on account with terms. But in reality, firms are not all one or the other. There's a wide range of mixture, and different clients might actually negotiate different terms. The important thing for us is that we're going to need to come up with a method that would deal with the differences between a company that sells for cash, one that sells for 30 days terms, one who sells for 90-day terms, and how is that going to affect their balance sheet? Because if they're offering terms, they're going to have to charge a price for their product that reflects the value of those terms. Say the 90 days of credit, their price is going to be a little bit higher. Similarly, on the seller side and the buyer side, if the buyer's receiving 90 days of credit, so suppose I'm buying something, I get 90 days of credit, because that value of those 90 days, it's going to get reflected in my COGS. I'm going to pay a slightly higher price in order to get a product that comes along with 90 days of credit. So we can see how these things are going to be affecting the income statement and effectively the balance sheet also, because we're going to have different levels of accounts receivable and accounts payable. Going into the details of that is going to be the topic of another video. Thank you. I hope you've enjoyed this video and all the other videos in this playlist. Have a great day.